Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
It's the 26th of January 2022. A very happy Republic to everybody. And I'm recording this ahead of what is going to be the Fed event and 1 week ahead of the Union Budget 2022. So taking a view on markets ahead of time has really not fretted me ever. In fact, the best part is if you can actually get it right, and trying to stay ahead of the move and putting your neck out is one of the ways that we win in markets. And if you don't have a system that allows you to do that, or fear is your enemy, then you have a completely different problem that comes in the behavioral finance part of the subject. But if you have sort of figured it out, why wouldn't you follow a system that allows you to be 60 to 70% of the time right? And frankly, you never know when you're going to be wrong. So the only thing you can do is be as objective and as confident of every opinion that you really put out, because you cannot know which opinion is going to be right or wrong. You just know that the methodology you're following will eventually get you to 70% or more. And so that's how I always look at markets. And like I said, when fear is the enemy, then you have to use that against yourself. It's not easy. Not to say that Monday I was not scared of what was happening in the markets, but I just know that when you're most scared and everybody is being shaken up and probably missing something, and I'm putting that very, very mildly, because I think the sentiment there was very, very gruesome. A lot of people ended up possibly closing out positions, selling off, and saying this is like the worst situation, because even though last week's correction appeared painful, stocks did not decline significantly, especially in mid caps on Monday. And Monday it was almost across the board. There was nowhere to hide. So the feeling was really painful. And so in that situation, what do you really do? Do you give in to your fears, or do you get greedy when everybody is fearful? Now, of course, you cannot really pinpoint when everybody is fearful. But from the behavioral finance aspect, what I found over time to do is be able to judge your own emotions. And if you can judge that you're being too fearful, then what you just need is the right set of technical indicators to tell you that this is the time to be on the opposite side. So that's sort of how I took it. Like I said, we can always be right or wrong as long as your methodology works with a high success ratio. That's completely fine. And it's also okay that you can't catch every bottom. Sometimes you'll get it perfectly. Sometimes you'll be battered before you get it. But the real question is, can you really hold on to that opinion because your system says that's what you're supposed to do? And that's, I think, that's where the whole behavioral finance and mental aspect of markets comes in. Now, having said that, that was the discussion on Spaces. There were several other points I would have wanted to make. I don't know if everyone faces this problem, but at least on Android so far, I tried 2 different phones and I got thrown out like half a dozen times. And if that's the issue, I found a lot of people saying yes, they also face that from time to time on Spaces. But I did notice there are people, many of the speakers, who didn't face that. And so the only option is next time I'm going to use an iPhone instead of an Android. And if that too gives in, then it's a different problem. So maybe it's the Android versions that are on the edge right now, and probably Twitter needs to correct that. Might not really be a network issue thing, because I'm running on a good network. Everything seems to work during the day. So I have no reason to believe that the network is causing me to get thrown out of Twitter, because Twitter crashes. It's not like your connection goes down if your voice is not going through. It's that the app itself crashes right in between when you're on the Spaces. So anyway, that was that. But yeah, I'm going to respond to some of the points in the discussion that I wanted to put out. But before that, I also came across an article yesterday that was written by Shankar Sharma, trying to corroborate that 2021 feels like Y2K. And it was pretty interesting because it's not an unfair feeling when you look at things like high valuations, high PE ratios, and especially a lot of these new age IPOs that came out at super high valuations. But the way the bubbles work is that first you get well-known companies that come out and list at high value. And once that happens and their growth momentum goes on, then many smaller ones start lining up and people start running and chasing every other name that has the same thing behind it, which is exactly what happened in the tech bubble, right? It was not just technology stocks that were doing well, but any other company that would put the word tech in their name would simply do well or get listed at crazy values and get lots of oversubscriptions, whether it was in the India or whether it was in US. US, you had situations like where tech companies with no earnings or losses would also get listed at crazy values. So that's what typically a bubble does, and then you have to really judge which part of that bubble are we in. So what he went on to explain in his article is that he was noticing that in the investment banking space, that companies with very small revenues are now coming out for high valuation listings. Now the only thing you'll have to judge is whether you're on the early stages of that cycle or late stages, and because sometimes these things can go on for 6-12 months before you really reach the end of the road, and so that's where the call gets tougher. I'll not argue on the observations because they are probably not wrong in terms of what is happening. We also seen huge drawdowns in some of these new listings, and the big question I'm finding in every media interview is people actually asking about, okay, what do the drawdowns in these listings, whether it's Zomato, Nykaa and so on, really mean? Are they opportunities to invest in them, or is it like, it was just high valuation bubble that popped? For me, unfortunately, the way the IPO market has really changed between what it was in 1992 and today has sort of put me away from it. My first investment in an IPO was in 1991 or two, late 1991 I think, and that was the last time I ever applied for an IPO. So anyway, there are IPO traders and investors, both types. I've always found it fair enough to let it get listed, wait for time, and then take a view. For example, you have had Just Dial get listed, and with crazy values at the time it got listed as people thought. The stock eventually gave up, and now after it's being taken over by Reliance, is actually showing some momentum coming back, and people are talking about the potential turnaround in that story. So it took its own time, and so if there's time, you can always get a good company at a better valuation after it's been listed, unless the growth momentum is so strong that it justifies those valuations. So very tough call to take, which is why I've sort of avoided IPOs in general, because I can always try and figure it out later on. My approach has always been bottom up and not top down. So then when you take a bottom up approach, you always look for value first, and if you don't see value, then you don't want to risk taking the valuation and momentum bet right at the start when a company is getting listed, because it also depends on where the market itself is, right? So if the market is in an environment where it's giving high value to those companies, then they may do well for the time being, but you don't know how they'll do once that value bubble really pops. And so that's the tough thing. And will that really be a market-wide issue, which is what Shankar was probably trying to highlight? I don't know. Right now, I don't see the whole market having run its course. So if I look back at my own experience with the tech bubble, I think once it started, every other stock started to participate. Many sectors moved up. So the hardcore economy stocks like Reliance, ACC, many of them actually, and Larsen, all of them moved up through the tech bubble, made what we call in relate wave terms of 5-wave advance, and then topped out. So we ended up getting the wave one of the next bull market at the time the tech bubble was brewing. But then at that time, many of these companies had not turned around in terms of their economic performance. And so once you got a correction, they all did wave two. They didn't make a lower low at the end of the tech bubble. But of course, at the end of the tech bubble, many of those unknown companies that came on the back of tech names got wiped out. Some of them are not even around anymore, or still struggling to come back. In fact, I don't know, I think if I'm not wrong, HFCL was one of them, which Shankar probably betted on. And for the next 20 years, it's really not making a comeback. So that's what you really need to avoid. I'm sure he himself states that. He says he got lucky with those investments. But in a boom, in a bubble phase, everything works. Even the junkiest of names give you very high returns, which is why people chase mid and small caps. And it doesn't look certainly that trend is over. At least I'm not able to make that judgment. So to say that the small cap bubble has busted, we're still seeing consolidations when we look across stocks in the mid cap space that have done well over the last 2 years. It's not like they're going 5 circuits down and crashing apart because they were overdone. They're simply going through a consolidation on the weekly time frame, finding support at weekly levels and trying to come back. That's what I'm noticing right now. If that pattern breaks, I'll probably be forced to give up as well. But that's what I'm hanging on to as of now. With that, I'll move on to the other part of the discussion, because if you heard these spaces, at some point became a long debate on, started with the bond market, because there were some different views based on, the long short strategist and then the fundamental top down approach. So different views that you would have heard from each of the participants, both bullish, bearish and mixed, because they would have had long and short views simultaneously on the market. and then it became a function of how should you be positioned, in terms of the alpha that you're trying to generate. But yeah, one of the discussions came around, I think it's natural, bonds, inflation and commodities, and those are subjects that I speak about a lot. I couldn't conclude on it. Patik of course referred to why bond yields were actually coming down when the market was falling apart, and so that brings me to the interesting part of the story. If you really watched this market for long enough and heard the words risk on and risk off, what I've come to notice, because there's a risk parity trade in the US where a lot of funds allocate money through hybrid funds either to equity or to debt, which means when they are buying equity, they are selling debt, and when they are buying debt, they are selling equity. That also sort of causes an inverse correlation between bonds and equities. So what that means is if bonds are going down and equities are going up, basically bond yields are going up when equities are going up. Now, this comes contrary to people's thinking, where you would say, well, if bond yields are going up, it's bad for the market. But you can look at all of 2021. US equities were rising for all of the year. I think they made their all-time highs just in the first week of January of 2020, this year itself, before this recent correction. And throughout that time period, for the entire year, bond yields were also rising. So whatever bond yield-based fears people would have cooked up would have fallen on their face in any way. So just because you're getting a correction now, to blame it on bond yields is completely nonsensical, because bond yields are going down because markets are going down, so which means markets down, bonds up, which is again the same risk parity trade, inverse correlation. And if bonds are going up, yields are going down as well, along with a market decline. So what would follow? Now this is where it gets interesting. If the market starts rallying from your US market and then bond yields start rising, is that the end of the world? So frankly, you have to somewhere segregate what the bond market is doing versus what Fed is doing on interest rates. The bond markets can go ahead of themselves. They're also trying to price in things like inflation, and they're trying to also price in if there's growth and we can make more money being in equities or commodities or other asset classes. Why should we hang on to the bond market where returns are as low as 1 to 2%? So that's the reason why bonds get sold off. But if interest rates are low, that sort of is the benchmark which sets rates at which corporates are borrowing. And if they start raising rates in an environment where growth is still positive, then US banks actually end up doing well. So US banking or financial stocks are actually positively correlated to rising bond yields. But I'll add here, and Patik's been a very good banking analyst. He pointed out one of the theories which I know he told me even in 2002-3, that if bond yields rise in India, there's actually a different relationship, that initially banking actually doesn't do so well. So it may do well because the economy is picking up and there's growth, but their margins do come under pressure, and so that becomes a concern. So then you have to take the bet not based on how bond yields do, but more based on, fine, the economy is doing well, and so the financial sector will grow, and that's got to be the real bigger bet, rather than on spreads. But for the US the banking space, it's very different, where rising yields end up leading to higher spreads, and people actually end up buying financials. A very, very different trend. But what ends up happening nowadays is that when financials do well in the US, financials end up doing well in India and everywhere. So these asset allocation plays are also become very, very linear across world markets, because we are in a globalized world now when it comes to investing and money flows. So the same sectors sometimes do well, the same sectors underperform from time to time, and you have to pay attention to that. So similarly, main concern around bonds comes from inflation, and so there was a lot of talk about inflation. When it comes to inflation, you really have to think how much of it was transitory and how much of it was a monetary phenomenon. I've discussed this before, and I'll say it again, that a large part of the inflation we saw in the initial phase of the pandemic was supply chain based, and that is why I think the Fed thought it's transitory. Subsequently, because of rising commodity prices, it has sort of become more persistent, which is why they are concerned. But is it really been a monetary phenomena? And if you look below the surface, you'd actually think it's probably not. There may be some component of it. I'm not completely denying it, because things like rising prices of gold, which were there for the early phase of 2020, were monetary phenomena. But when it comes to at least the metal sector, a lot of it has been driven by not just the demand expectation from EVs, but actual steps in the last 6 months, as we've seen in the period prior to that, which has been export led, because China is actually pulling back on its own production, because they want to make their airspace more greener, and their move towards a greener environment has meant that they've pulled back on production of various commodities and industrial production in general. And so the moment they've done that, it has meant that demand for those commodities from other places like India actually goes up. So India is actually a beneficiary of that trend, and that's also keeping commodity prices elevated, very similarly as OPEC has done in the oil market. And now in 2022 you're going to get the lowest amount of new production coming online for oil because of fewer discoveries and smaller capex in the sector. And that means that even if OPEC is raising production slightly, it's not really going to bring down oil prices, so they will remain elevated. So when you're going to get elevated prices, and so all of these factors are playing into keeping either oil elevated, China's production cuts will keep commodity prices elevated. The interest rate hikes are really not going to bring down prices. What you might do is, okay, you flatten them for a while, okay, you get a consolidation in commodity prices, which you can on a base effect basis year on year bring down inflation, and then eventually, and I think one of them did agree to that there'll be a back and forth on inflation, and I think that's the view I'll probably go with, that inflation will cool off and then again it will pick up, as prices start moving up again, which they will as the demand environment continues to improve, not just in the US but now around the world. So US has already had its demand environment get overheated, which is why the Fed maybe feels it should step into some degree on rates, and a few small hikes might not completely derail the whole environment and create a debt debacle, as they want to call it, an environment in which bonds and equities both crash. So that's something we've not seen yet, except during the 1987 crash, and unless we see that very, very clearly, it's not something we should be fearful of. And so we should consider that every correction till that is happening is a routine correction. So that's the first thing to keep in mind. And inflation as such will then, once it goes back and forth based on demand environment, I think commodity prices would rise again, maybe not at the same pace as we saw in the first leg. Maybe that speed slows down, but they will continue to advance, and which will continue to bend positively for the metals sector. So that's one part. So that's a sector that I'm not going to particularly back off from. But if I'm really asked which are the sectors that are going to do well in 2022, I'll align with one of the gentlemen that banking can actually be an outperformer in 2022 compared to 2021. See, in late part of 2020, I think September to March, the bank index actually did very, very well. It had a sharp rally, and then after that it's not been able to perform. Part of the reasons told to me are over ownership by institutional investors, specifically foreign investors. Now that's a fair enough reason, and there's some pressure points based on the losses from the write-downs from the pandemic and so on. But sort of if you look at the growth that you're now seeing in most of the large banks, that is behind, and retail lending had picked up in the last quarter before Omicron hit. And apart from the negative effects of Omicron, I think once that passes us by, what you'll really be looking at is growth reviving, and especially if government steps in on spending, which is another of my expectations through the budget, because they have huge room to do so. So I have no reason to believe why they would not use the room, because if they have a tax windfall and the fiscal deficit really falling down significantly, and why wouldn't use that space to really kick off growth on a higher trajectory, especially since 2 years down the line they're going to face national elections. So I'm more focused on the national elections than thinking of what will they do for the agri space, because they're going to face elections in the near term, 1 month and 2 months. They may do some small props there, but on the bigger side, I think they have room now to really put out a clear-cut plan on infra and spending for the capex cycle to kick off through this budget. So if that happens, then you have the demand environment on various other fronts coming up, whether it's capital goods sector, the metal sector, and so on. That I think, and eventually those loans, when you have large investments which happen basically in the capex cycle, it's the large banks that are the ones that end up lending there, and they are the ones that should do well. So that is why I think banking somewhere this entire year was a consolidation. Even wave structure wise, Elliott wave wise, we've marked it as a ABC consolidation in a rising channel, so sort of a running correction as we call it. And 2022 I think then starts a fresh impulse, which is already started. It's already visible on the charts, which will then eventually lead to much higher levels. So I think it's time for banking to start outperforming again, along with the rest of the stocks. But places where I've actually seen impulsive structure include many other sectors that I've written about. I think yesterday I put out a couple of posts. We'll share them on social media. But one last factor I'll talk about, which was also mentioned in detail by one of the other participants later on in the discussion, And this was regarding the fall of volumes, so you were suggesting that volumes have really declined, and so this entire rally is being led by leverage. And I would want to step back and look at why these volumes decline. See, if volumes decline in a normal market environment, yes, they can cause an end of rally. But this decline in volumes has actually happened with SEBI taking lots of restrictive steps in the last 6 months on the margins. So there were significant steps that have caused this decline. It's not just happened for natural reasons. For example, earlier you could easily do intraday trades. Now they've put limits on how many times you can have a position on intraday. So that sort of reduced the amount of trading you can do intraday with whatever capital people were putting up front. People were also using their stocks as margin in various cases. And also, if you sold stocks, for example, if you're selling stocks in the cash market or buying fresh stock, you didn't really have to have margin because you could pay 80+1 settlement. Now they're saying, no, you should have upfront margin before you even buy a stock. I mean, those kind of things sort of slow down the process. They stop, people from taking decisions which they would have done ad hoc. In the equities, many times we work with our feelings, and those ad hoc decisions take place to buy or sell, and then you pay for it later on in a day or two. Sort of all that comes to an end. And even if you sell stock and think you want to buy something in FNO, now you can't do it on the same day. It is a T+1. You sell only when the margin comes in, then you can buy on the following day, and so on. So there are a lot of those cross things you could easily do. Sell options and use the margin for buying stock, or sell a stock and buy something else. Those things are now restricted, and you end up being hit by a penalty. And so for that penalty, a lot of people don't end up doing that. I think many of these measures are really the reason why volumes dropped off after May, June and July, and then they put more restrictions in August and September, and volumes have dried up since then. So the way I look at it is, once volumes have dried up, I'm only comparing the September, October volumes to where we are in Jan. So in January, we did see a slight pickup in volumes as this rally was going on. Still, it didn't reach the peak level seen in October. And so I was wondering whether it's a concern. Maybe that's the reason you got a steep correction. Now, the lower volumes do ensure that, moment you get some sizable selling like you got from FIs, the market tends to move very, very sharply. So that's one reason why this was one of the deepest retracements that we've seen in Nifty since the market started to move up since 2020, right? Every time we had a pullback, 38%, I've seen 50% in smaller degree wave twos, but this second wave correction retraced 78.6% till the low that we made on Monday at 16,830 was the level for 78%. It came to 16,836, very close, but deep retracement, deepest since for all the second waves that we've seen in this period. And the reason might just be that the volumes. But that doesn't necessarily entail that there's a trend change. Have we really reached a point where retail has overextended itself? I think retail's entry into the market is a secular trend. So I agree with that, along with a couple of other people who are there over the weekend. That's a massive trend change that has happened right from the start of the pandemic. Everybody wants to be participating in this bull run. Just because they are starting to participate doesn't necessarily mean the end game, which is why when you look at SIP flows, they're strong month after month after month. People are continuously investing into this market. Unless you really disturb that, which will only happen when there's a very, very sharp sell-off, or when everybody who participated has put in their money in, extended themselves and got fully invested. That takes time. Some people are just still joining the market, and then they may be putting in their first investment. So that might not be the time when you call the end of this. You can say we're entering the end game, but how big will the end game be before it pops is where we can all get caught up on the wrong side. So I don't want to take that call till we really see excesses across the board, and till that happens, I'll probably look at corrections that are part of the overall upward trend. On the other hand, maybe I only end up spotting the reversal in hindsight. So once some key level breaks, and we are not, in the medium term, not making lower lows and lower highs, which we have not done so yet. I think the next lower low would be probably 16,410, which we made last month, and compared to where we were in April of last year. So that higher low pattern, despite deep corrections, continues. Unless that pattern really changes, I don't think the larger trend reverses. We'll continue to look for each dip being part of the overall upward trend, unless we get excesses on the upside. So that's how I think of it. Volumes have been have pulled off, but are still there. They're not completely gone away. The reason they went away was whatever has gone away has been more because of the margin action that was put together by SEBI itself to probably reduce excessive leverage in the system. In a way, they might actually, later justify that, see, this was a good thing because we didn't allow people to get overextended. They've continued to invest and the market has actually slowly drifted higher. You can come up with an argument both ways based on what the market eventually ends up doing. So that's all from me. The way I look at the tonight's event from the Fed will be very, very simple. It's that if the Fed is already pointed out what it's going to do, if it just clarifies what it's going to do, the market would have sort of discounted it. Say, for example, it says, okay, this is it. We are going to do this rate hike once, twice a year for between now and then that sort of clarifies the plan, because a lot of media reports continuously saying, oh, they'll raise it once, they'll raise it thrice, they'll raise it twice. And, the idea keeps changing and the market's been gyrating, trying to discount that factor. So once they put clarity to, what their plan is and how they'll go about it, then I think sort of it would be discounted and you would start seeing the markets actually recover from here, starting to price in the earnings growth rather than fearing about interest rate hikes. That's, I think, the way we are going to look at it. I think the commentary, so basically it's going to be more about the commentary, because so far it's all been about Fed talk, right? All the market action has been based on what they are talking about, not based on what they're doing. Of course, now they have at least committed to one part of the story, that they're going to be tapering down till March. And so I don't understand why they will raise rates now in this particular meeting. If anyone has any expectations, they probably wait first for the tapering exercise to complete, and then they'll move into the rate hiking cycle. And if they do, they'll probably, as always, give us an advance notice in terms of what they are planning to do. This is one of the ways I think the Fed has worked, is to use policy tools through communication. That's been a large part of it, because once they communicate it ahead of actions, then that sort of prepares the market for it. You see it behave much more normally. You really wait for the time when these rate hikes become a serious problem in terms of the cost benefit to earnings, and so that's when the markets would really get concerned. I don't think the first hike is that point. Will it be after 4 hikes? Maybe, I don't know, but we'll continue to watch out how the bond market and equity market behave, because like I said, it's only when bonds and equities both are falling together, which means yields are rising and equities are falling simultaneously, is when you're in a debt debacle, some kind of a crisis. At all other points of time, if equities are falling and bonds are rallying, it's simply a risk-off trade or a normal correction where equity money is moving back into bonds as a safe haven trade, or what we call the risk-off trade. So we'll probably catch up after the union budget. Maybe it'll make more sense to catch up on this once we can really look at how the markets responded to that and what else we really have in store. Right now, my expectations remain positive.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.